Welcome to Gold and Silver Assets. It's Sunday, the 28th of June 2020. Gosh, we're already halfway through the year. So last week we were puzzling over why the gold and silver lease rates are negative. So I thought this week we'd look a bit more closely at this topic. And it turns out that I may have bitten off a bit more than I can chew. This is actually quite a complex topic and it is associated with a degree of opacity. So getting in-depth information on this has been tricky, and I'm by no means an expert on this area. But I thought, what the heck, let's have a stab at it. So here's my take on negative lease rates. So we'll start with the definition, and basically a gold lease rate is the London Interbank Overnight Rate, or LIBOR, minus the gold forward offered rate, or GOFO. Now, effectively, the LIBOR is the interest rate on an unsecured US dollar loan, whereas GOFO is the interest rate for swapping gold for US dollars. And the gold lease rate is the interest rate for an unsecured gold loan. That is the risk premium in case the gold isn't returned minus the storage fees. The LBMA stopped providing GOFO data in 2015, so all data since 2015 are implied rates. And so remember that they don't necessarily relate to what's actually going on in the real world of gold and silver leasing. In the last 6 months, we can see that there was a sudden drop in the gold lease rate in late March to -6%. And then there was another spike down in late May, down to -5%. And it's currently at around -2.5%. For the silver rates, there was a sharp drop in mid-April down to -3.5%, and then another drop to almost -4% in early June. And it's still hovering at around the -3% level. Now, some commenters in last week's videos commented that this may be due to manipulation. And certainly, while I think all markets are manipulated to some degree, it's not something that's particularly new, and saying the words manipulation doesn't really provide us with much information about what this actually means and what its implications are. So the first thing I wanted to know is, has this occurred before? So this is a chart that goes from 1989 to 2015 and shows the gold lease rate in red and the gold price in yellow. So up until the year 2000, there were multiple spikes in the gold lease rate, and they were always positive. During that time, the gold price remained relatively flat. But we can see that since the year 2000, the lease rate has stayed close to zero, except for one large spike in 2008. And there were episodes of negative lease rates, but none exceeded that -1% level. And so the -6% is something that's very new and very different. We haven't seen that in the last 30 years. This chart shows the lease rates for both gold and silver from 1999 to 2012. And there doesn't seem to be any particular link between the two. And again, since the lease rates are mostly positive, with no episodes reaching -3% like we have today. So for both gold and silver, such highly negative lease rates are something very new. So what does this all mean? Well, simply put, when the lease rates are low or negative, that means that there are more gold lenders than borrowers. Now, it's important to note that this is not at all related to the supply and demand in the spot market. That's a very different thing altogether, so don't mix those two up. The other thing that people have found is that there is no statistical correlation between the lease rates and the gold price. So when it comes to lending and borrowing gold, who are the main players? So certainly the big lenders are the central banks. In terms of the big borrowers, they are the miners, but also I think they might well be ETFs. And of course, we've got the middlemen, which are the bullion banks. So knowing which players are involved may help us to look at the factors which may affect the lease rates. So first of all, we have central bank supply. So if central banks add gold into the system and provide banks with extra liquidity, that would, in theory, decrease the lease rates. So certainly if we look back in March, I highly suspect bank liquidity would have been an issue. Next, we have producer hedging. So when there's negative sentiment about the gold price, then the producers tend to sell their gold forward and borrow gold in the interim. And so, i.e. they are hedging. So when there's less hedging, the decreased demand for borrowing gold would push the lease rates down in theory. Another factor is private investment, and this is a factor that I'm really not very clear about. I would have thought that less shorting would mean less demand for borrowed gold, and therefore that would decrease the lease rate. But also less ETF inflows would mean less borrowing and therefore lower lease rates. But I'm not sure if I've got that right. My brain started to hurt when I tried to look at the link between the commitment of traders, ETFs, and the lease rates. So anyway, let's have a look at what actually happened with these factors by looking at some charts. When we think about central bank leasing, that's actually not information that's publicly available. This chart was actually one that was made by the author's own calculations and estimates, and certainly we don't have any data for what's been going on this year. According to this chart, leasing has steadily decreased since the year 2000. However, I did find some data for the Royal Bank of Australia, which confirms that gold loans reached their lows at around 2011 to 2015 and then began increasing, but certainly not to the level seen before 2010. What about hedging? If we wanted to try and explain a negative lease rate, then one option would be through a dramatic decrease in the demand for gold loans through decreased hedging. And certainly miners have had a decreased demand since the year 2000. And hedging remains at a low even today. So not shown on this chart, but the 2019 level was 8.3 tonnes. But remember that hedging has been decreasing since 2000, and unless there's been a dramatic spike in the decrease, again, this doesn't completely explain things. Certainly, though, I would say that a lack of hedging is a sign of positive sentiment about the gold price. The other factors that affect gold loan demand, I would have thought, are things like the open interest and ETFs. And this is where things get quite fuzzy. Currently, the open interest for gold is at near record highs. And so I would have thought that this would have actually meant greater demand for loans. If we look at ETF inflows, for gold and silver, they too are at record highs. Now, on this chart, it actually misses out the data that's recently, which is now at 140 million ounces, which is above the top of this chart. So if ETF inflows are at record highs, I would have thought that, certainly my understanding is that many ETFs use leased gold. And so I would have thought that that would mean that we've got increased demand for borrowing, and therefore that would actually increase the lease rates. Now, if at this point you've come to the conclusion that you're more confused than when you started, join the club. As I said, precious metals leasing is not transparent, and there's a lot of data that isn't publicly available. But the upshot of all of this is that one thing we can say is something new seems to be happening in the system that hasn't happened for the last 30 years. I just don't know what exactly it is. Next up, the market update. So let's start with gold in US dollars on the monthly scale. So this is a big picture view here. And we can see that we've had a fantastic run up in gold. But there's a few important things to remember here. So the first thing is that the price never goes up in a straight line. So even during this run, we've had pauses through consolidations here within this upward sloping channel. If we look back at this big bull run here, most of the green bars are usually about 3 or 4 in a row before we have a bit of a rest with 1 or 2 red bars. And at the moment, we're currently on the 3rd green bar. So that's one thing that tells me that we may have a bit of a rest. Now, just because I say that doesn't mean I'm bearish, because remember, we are still in a strong uptrend. So I'm actually very bullish on gold. The other reason why I think we may be having a rest coming up in coming weeks is that we've hit this resistance area here. So you can see that the 1800 US dollar level has been significant resistance for 3 times here, in fact. And then it actually gave up at that point. And we haven't even tested that level yet. But I suspect that is going to be formidable. But the other thing to remember, this area here is highly likely to be support. And that fits in with the support over here as well as here. So we're looking at around 1,560 US dollars as being strong support, and that would coincide with this lower trend line here. So if we do get a break, it's not necessarily going to be catastrophic, and it may not even reach these low levels. It may only go maybe to halfway down this channel line. Certainly, I would say that gold has been acting very resiliently, and you can see within this channel that the lower wicks have been quite long. If we look more closely at gold in US dollars on the daily scale, we can see that we broke out of the recent consolidation range here. And I did say that we do have a little bit of headroom. So it's quite possible, since we've made a new high here and we remain in this uptrend over here, that there could be a little bit more upwards movement in this. That's certainly where the momentum seems to be directing us. But I think that the resistance level is going to be at or before the top of this trend line, and so this level here is at around the 1810 US dollar level. Obviously, if we see a break in this upward sloping line here, then that would signal a little bit longer break ahead of us. If we move to silver in US dollars on the daily scale, and again, we're in a strong uptrend. We've been moving in this upward sloping channel, but price is spending quite a lot of time in this area between $17 and $18. And it looks like we're forming a little bit of a triangle here as well. Now, these triangles can break out in either direction, so it doesn't tell us where we're going. However, since we do have this upward sloping trend line, if we do break and close significantly below that, so I would say if price starts dipping below around the 1750 level, then price has the potential to drop below the $17 level, in which case we're looking at a target down into the 15 US dollar levels. But as I've said before, I think that's likely to produce a reasonable amount of support there if that does happen. If this does break out above around the $18.04 level, according to this line that I've drawn here, then we're looking at an upwards move. But this isn't going to be plain sailing, because this upper trend line that I've drawn here has been resistance in the past, for example here, and we would need to break that. Now, if it does break that, I think it's going to be a huge break, and we're looking at going up towards the 27-28 US dollar level. And silver's the kind of metal where these prices can move very rapidly and it can get away from you very quickly. What's my gut feeling on this? I think one more little dip down. I don't know how much by, but I think that'll be enough to shake out any of those last remaining weak hands. And then I think probably it's going to start making its move. I don't know exactly when that'll be, but it just feels like we're coming towards the end of this very long bear market here. Just for a change, I thought we'd look at the silver miners ETF. So this is for junior silver miners. And this is on the weekly scale. And I've drawn this channel by joining the highs, cloning the line, and joining some of these lows here. And I've also drawn a roughly midline channel line here as well. And we can see that we are in the upper half of this channel. Possibly this could be a flagpole, in which case an upwards breakout would be huge, and we'd be looking at a target of $20 here. Do I think that's going to happen again? It really depends what we're going to see in terms of silver and gold and the general stock market. As I said, my feeling is that we just got one more dip down. If silver price goes down to 15, then I would think that this would go down to around the 7 level here. And if we look at the Fibonacci retracement of this whole move, that would represent a 61% retracement there. And of course that fits in with that resistance level that we're seeing here. And again, this is just mere speculation, but if it does hit that level and bounces off there, then I think there's a good chance that we may well move upwards and break this upper trend line. And moving on to the gold miners, so this is the GDX on the daily scale, and we've actually remained above the 32 level. That $32 level has been crucial, and we've talked about that quite a lot in the past. And we certainly have broken out from this short-term downtrend, but it gapped up, and that gap hasn't quite closed yet. And remember, we've got lots of gaps below, which seem a little bit untidy to me. Can this go up further? It certainly can, and certainly if gold does take a stab at that $18 level, this could go up a little bit more. But as I said before, I'm just going with my gut here. I'm just not feeling it here for the miners yet. Might be wrong, in which case it doesn't really matter because I'm already in. But a buying opportunity would be very welcome. My gut says that we've gotten one more down move, close some of these gaps, and the next move will be probably massive. That's my guess. Now remember that when I talk about these things, I do think about things on a longer time scale. So this isn't something that's going to necessarily happen next week, or the week after. It does take time for these things to unfold. If some of you remember my videos from earlier in the year when we were around here, you may remember that I was talking about these gaps that had occurred back here, and people were very bullish about the miners around this time, and I was talking about the potential for this to be a kind of double top, and that would give us a target of around 20, and that would have enabled us to close those gaps. And some people might have thought I was a bit nuts thinking like that, but again, that was just my gut feeling, and I just got lucky there. I don't know if that's the same case here, but again, I'm just getting that same sense that we just got one more dip. But remember, I do think that it is the last dip, and things are going to move along later in the year quite dramatically, potentially. So that's it from me this week. Now, I just wanted to say thanks for all the comments. We've had some interesting discussions coming through, and it's so nice to be able to talk to people about this stuff. There's no one in real life really that I can discuss all this stuff with easily. Most people seem to glaze over before I even start. So anyway, it's nice to have you all here. Some people have asked for a video about silver, so I'm just working on that, and hopefully I'll have it ready in the next week or so. If you do have any specific questions about silver, write it in the comments below, and I'll try and incorporate as much as I can in that video. Anyway, nice to have you all here. We will see you next week. Don't forget to like and subscribe. Bye.